Trade tensions continue this week, with China promising to retaliate after the US threatened to impose another $200 billion of tariffs on goods. My next guest said that emerging markets could be set for a 15% correction. Joining me now on the phone from Shanghai is Brock Silvers, Managing Director at Kaiyuan Capital. Brock, thanks for joining us. How considerable is the deepening trade conflict between the US and China when it comes to the global growth outlook?
Well, I think it could well be very significant. I don't think we've yet hit bottom in terms of the Sino-U.S. trade relationship. We've just seen Donald Trump promise we have $2 billion in tariffs in the pipeline. Now, I think there's probably an 8-week window before they go into effect where we could see a deal. If we don't see a deal during that period, then I think we might want to prepare ourselves for a longer term and perhaps more intense confrontation.
So how do you see this trade war playing out? Do you think it's going to be more tit for tat between the US and China, or are we likely to see the resumption of negotiations anytime soon?
Well, I think again, we will see negotiations for 8 weeks. After that, it's anyone's guess. But whereas Beijing has a number of potential response options right now, none of them are very good. Beijing could sort of go into a tit-for-tat mode and raise tariffs, but they simply don't import enough from the U.S. to keep pace. They could take it a step further and say that we'll continue to ease the RMB. But they can't do that for a very long period without weakening their own economy, with hurting their own sort of consumers and investors, and encouraging capital outflows, which just last year they worked very hard to limit. They could take it one step further and say, look, we're going to divest our U.S. Treasuries portfolio, but not without harming the value of their own portfolio, and then Beijing is stuck with a pile of liquid cash and nowhere to put it. That would also be problematic. I think with what I'll call indirect responses, that we could be less cooperative on North Korea or elsewhere. We could be more antagonistic towards U.S. business interests in China, but those won't be very satisfying responses. I just think that given a booming U.S. economy, a slowing Chinese economy, and a global environment of rising rates, the terrain really favors Trump and the U.S. at this point.
Now, if we look at European autos or the Chinese stock market or indeed the renminbi, clearly the trade tensions are weighing on markets across the world. Which asset classes do you think are likely to take a hit going forward, and how do you see this playing out across markets more broadly?
The Chinese market certainly does not like the possibility of a trade war, and there have been days over the last couple of weeks where without circuit breakers, the market simply would have melted. We had one day 2 weeks ago where more than 1,000 listed shares all dropped by the maximum daily limit of 10%. That would have been an absolute rout had those circuit breakers not been there. So Chinese equities are certainly in for a wild ride until this issue is resolved in a more thorough or substantive way, and that probably won't be quickly.
Now, putting the trade war to one side for a second, we've got Chinese growth figures out next week, and I want to get your take on the outlook for the Chinese economy, because some say the reason why we're seeing the depreciation in the yuan is because of flagging growth over there.
Well, there certainly is. Look, the Chinese economy is slowing, and I think Beijing is aware of this, and that just makes it more difficult to have this strident discussion with the U.S. while you have a slowing economy, which is why I think that Trump has the upper hand, because he's dealing with a booming economy at the same time China's trying to deal with him with a slowing economy. But there's no question there is a real slowing occurring.
So do you see further upside for dollar CNY?
Yeah, it depends. It depends how political China wants to get and how it manages the currency. The thing to remember here is that the renminbi is not free floating. It's government controlled, and in this government, I think politics does play a significant role. They have pledged so far to not use the RMB in a political way, and so far there has been weakening, but it's been mild. They could perhaps go for a stronger weakening, but again, that would be also a painful process in China.
And put their credibility at risk, arguably. But let's take a look more broadly at emerging markets, because you said that as a whole they could correct by 15%. That's a big call. Why are you so pessimistic?
I don't know if I'm pessimistic. What I would say is that, look, the global economy is in the late stages of a very long bull market that's been fueled significantly by massive easy liquidity. And that liquidity surplus has been felt, I think, across asset classes, but it certainly has been felt in terms of emerging market equities. And now we're in a period of normalizing rates. And as liquidity normalizes, I think some of that capital will naturally kind of seek the safety of developed markets. And again, the U.S. is currently booming, and at least for the moment, a very attractive market for equity investment. So I think a lot of those will pull emerging markets back. Now, emerging markets have corrected, I think, throughout this year, but I still think they have a bit of correction left in them. But before you call me a pessimist, let me say that I think that this is good news. It's going to create some misallocation of capital, some misvaluation, and it's going to allow value-based investors, I think, to do well, or at least provide opportunities to do well. Now, a few examples. Even in China, as I said, it's a very emotional market. In fact, it's driven by emotion and leverage, which is not always an easy combination. And I think trade risks will cause a lot of fluctuation in terms of valuations, and will provide an opportunity for valuations to reset at a more reasonable level. All we have to do is look at last week's Xiaomi IPO to see an example of valuations that had become overly disconnected from corporate performance and business model. So I think there will be opportunities in China, and I would personally keep my eye more on the SME market than on the large caps. Now, other potentially interesting opportunities: Vietnam, a booming economy, but not overly at risk from a Sino-U.S. trade war. Yet I could see them having extreme liquidity restriction pressures if there is a trade war. So I'd keep an eye on Vietnam, and particularly I like the consumer sector. Malaysia just had elections in May, and since the elections, I'm very pleased with reform plans. I think it's better than we could have expected. But yet the market has just taken a beating in that period. So I think if the Malaysian market keeps dropping, I'd be prepared to do some bottom fishing, and merely avoiding companies that are overly reliant upon government at this point.
Okay, Brock, thank you so much for your time. That was Brock Silvers, Managing Director at Kaiyuan Capital. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.